afternoon, everybody. I'm Khushru Pantaki, and I welcome panelists over here. We have a very esteemed panel today to discuss the impact of the Union Budget 2021 on the financial services sector. We have Mr. Rajiv Anand, the Executive Director from Axis Bank. We have Mr. Nilesh Garg, Managing Director, Tata AIG General Insurance. And we have Mr. Bala Subramaniam, MD and CEO, Birla Mutual Funds and AMC. In addition to this panel, we also have our own internal experts. We have Mr. Vivek Iyer, our Financial Services Risk Advisory Leader. And we have Mr. Amit Kedia, the Head of Taxation for Financial Services. Welcome to you all, gentlemen, and thank you for being there this morning on the panel. The impact of this particular budget on the financial services sector is fantastic, I would say. When I was hearing, generally there has been a tendency that as professionals, we tend to hear more on part B of the budget and just sort of, faintly hear part A of the budget. But this time, definitely, I must say that the part A of the budget was very, very interesting. Not that too many tax proposals are there or tax incentives are there, which are being rolled out as far as part B is concerned on the financial services, but definitely part A has been extremely interesting. The focus of the government is indeed on sectors like financial services, pharma, automobiles, and of course, finally, most importantly, real estate and infrastructure as well. So overall, a great budget. And we would like to sort of, open it up for discussion as far as financial services are concerned. Some of the key reforms that we actually observed in the financial services is, of course, setting up of the asset reconstruction company to acquire, manage, and dispose of the stressed assets or the NPAs. The other is, of course, in terms of recapitalization of another 20,000 crores as far as the public sector banks are concerned. The third is, of course, the privatization of 2 public sector banks and 1 public sector insurance company, and definitely, of course, the IPO of LIC, just to name a few. And of course, we will talk about it a little later on that front. But at the same time, I think the government has also sort of, emphasized upon the development of a world-class fintech hub at the IFC, which is based in Ahmedabad. So a lot of thrust on development, on growth, on some of the incentives. Affordable housing is also being discussed in the budget. So with this, I open up this particular panel discussion. And my first question is to Mr. Rajiv Anand. As far as the setting up of the asset reconstruction company is concerned. So, sir, of course, as you are aware that this was sort of, anticipated even before the budget that there will be something like a bad bank which will be set up to acquire these loans, which are stressed loans and all. Is it something very much in line with what's happening globally on this particular front? And how do you think this particular process will take shape over a period of time and sort of really address the issue which we all are currently facing, taking into consideration that this particular pandemic has also resulted in some of higher provisions which have been caused through the moratoriums as well. So your views, sir, on this.
Thank you, Khushru. Thank you for having me on the panel, first and foremost. I think the fact that the banking system has clogged arteries through bad loans, I think is well articulated. What the RBI has also indicated is that as you go forward, the expectation is that particularly from the retail side, NPLs are expected to be at an elevated level if stress continues. And so therefore, in a sense, there is a dichotomy from what the RBI has indicated and what the budget has indicated. So therefore, if we broadly believe that we're going to grow 11%, add another 4% of inflation, 15% nominal, the likelihood that RBI's numbers of 14% of bad loans in 21-22 look fairly elevated at this point in time. So, and if you look at the Q3 numbers as well of the banking system, the stress in the banking system has actually been significantly lower than what was earlier anticipated. What we are actually grappling with is the bad loans of the previous cycle. And that number needs to go off the bank balance sheets for the banks to be able to, sort of go back to lending, etc. One of the approaches that has been envisaged around this is is the formation of a bad bank, use the ARCs to be able to do this. Now, it is not that the ARCs are, is something new that we are seeing. ARCs have been around in this country, for many years. But unfortunately, most of these ARCs have had limited success, both in terms of resolution as well as their ability to, generate capital. And so, therefore, while the finance minister has spoken about the creation of ARCs, it is still not clear what exactly was meant there. Meaning that what is the structure? Will government be putting in money, or will the focus be on getting money from, for example, distressed debt? There is ample amount of money that wants to come into particularly into these markets, globally. But what is the structure and how that is going to work is something that we'll have to wait and watch. Second is that if the bad loans are moving from the bank balance sheets onto the ARCs, what is the price at which that transference will happen? If the transference is at book value, then we need RBI to, sort of bless that as well, because in a sense you're postponing the problem. But if the asset is going to be transferred at some sort of a notional market value, then the bank is taking the hit today, and therefore will then need capitalization, which then, who's going to provide that capital? So what is that? What is the mechanism for that transference? I think is critical as well. Um, and third, of course, is whether the private sector, whether the structure that is being envisaged is only the public sector, or whether, sort of there will be private sector ARCs which will also be encouraged, if not anything else, to, from a price discovery perspective, will be, sort of much better from that perspective. But my own feeling is that, yes, we should go down this road, but I think we've done a lot of hard work through the IBC/NCLT process. There's been a lot of case laws that have got created. A lot of wrinkles have got fixed. I think the sooner that we get back into that NCLT process, the better it is for us, because I do believe that fundamentally, because of the IBC NCLT process, promoters in this country, the relationship between the borrower and lender has fundamentally changed. We have seen many fairly influential promoters lose their assets. Hitherto, it's never happened over the last 30, 40 years. But over the last 5 years, we've seen numerous promoters lose their assets. And therefore, the relationship in that sense, as a result of that, between the borrower and lender has fundamentally changed. And therefore, for us to further encourage the IBC NCLT process to be able to resolve this will actually hold us in much better stead as we go forward.
So, Khushru, just completely agree with Rajiv. In fact, a couple of interesting points that he did mention was about, one of the biggest challenges essentially in terms of the whole sale of the loan portfolio has been the extent of haircuts that need to be actually applied to the portfolio. And RBI kind of needs to have some kind of norms defined there for the purpose of actually defining the price at which it actually moves. Second piece on the whole ARCs being well capitalized, that's a very well established problem that Rajiv very rightly highlighted as well, saying that we have many ARCs, but the biggest issue is the level of capitalization that they are allowed to. The level of capitalization essentially is a problem, and the ARC guidelines also expect. RBI guidelines also expect ARCs to kind of have some amount of skin in the game in terms of the 1585 rule. That also kind of limits. So, one of the important things for the success of essentially this ARC is going to be what's the level of capital that that's going to form. Also, the rules will have to be a little different for them. If it has to be successful, then the rules will have to be a little different. Where if a large amount of assets are actually being bought by this particular ARC, or pardon me, the word bad bank is kind of used colloquially to a great extent here. I'll choose. I also do that, and I know Khushru, you advise me not to do that because bad bank, good bank, and it's kind of very it has a very negative tone to it. But the interesting piece there is going to be in terms of we also don't have a very deep junk bond market in India. So if we actually need a very successful structure of actually having these kind of bad loans move into a ARC structure, we also need a secondary market for the purpose of deepening those pieces. So it's definitely a good step, because it's at least from a principally, it's a great step in terms of saying that these are there. And thematically it comes down to devil lies in the details, and the execution success would actually depend to a great extent on it. So that was just a few points. So I thought Rajiv brought some really interesting points. I kind of thought I'll build a little bit more from my side on that.
Thank you, Rajiv and Vivek. In fact, very interesting. And a couple of learnings over here is, of course, this has a lot of uncertainties at this point of times in terms of holding of capital, management, etc. But what I also envisage another problem is that even when the assets are going to be transferred to this asset reconstruction company, the valuations and other things could also be contentious, given the fact that what is the underlying security, how it is being valued, at what rate there is an agreement between the buyer and the seller. And definitely it is going to be a process where there will be a lot of learnings, both for the banks who are transferring their assets and the ARC as well. So yes, I would say it's a wait and watch, and maybe over a period of time, we'll come to know more about it. So thank you for sharing this perspective. My next question goes to Nilesh. Nilesh, you have led one of the very large insurance companies in the general insurance space over many years and been a professional within the financial services. A great reform, which we all were anticipating in terms of increase in the FDI limits for insurance companies, where the joint venture partner, the foreign joint venture partner, can now hold up to 74% as against 59%. Clearly a great move by the government, including the fact that there can be a control of such enterprises by the foreign JV partner with certain restrictions in terms of the number of directors, etc. I have been working with insurance companies over the last 20 years in terms of as a professional. And I have always experienced one thing, that even when the shareholding of the foreign JV partner had been 26% and in some cases 49%, there is a great relationship between the Indian JV partner and the foreign JV partner. What are your initial thoughts on this particular important legislation? And do you believe that many companies will tend to go that way in the near future?
So good afternoon, everyone. Thank you for inviting me to this panel, Khushru. And I totally agree with you, that this announcement of 49 to 74 probably, arguably, is the one of the biggest reforms announced in this budget. A lot of people had anticipated it and had been waiting for it for almost the last 5 years. So first of all, let me also share, while the Indian insurance industry was privatized, opened up for privatization in 2000, 2001, still the penetration levels that we see in India are very low compared to any of the developed countries or even the worldwide averages. So in terms of the protection which insurance industry can offer to for assets and the GI industry, general insurance, or in terms of life or health, still there are large sets of lives, health, population, assets, which are uninsured. So it's still, what I would say is, we sometimes, we see the growth and we see there's lots which has happened, but I think, there's lots more which needs to happen. Second, very rightly put by you, I think the biggest sore point, when 5 years back, when the 26 had moved to 49, it came along with Indian owned and controlled. And I think that was a very big sore point, which while, a lot of foreign entities could own financial interest of 49%, but they lost kind of management control, or that's what the regulation forced them to do. So I think, which to my mind, so there is the movement of 49 to 74 is one part, and the second part is, the management control. So I think, a lot of and I have interacted with some of these JV partners, foreign companies. I think, their entire commitment to India, the country, the market changes in the moment, there is management control. And we have seen that happen in the reinsurance space when, all the reinsurers were operating as overseas branches, vis-a-vis, when the regulation allowed them to open a foreign branch in India. and suddenly the risk remained the same. But I think, the level of commitment, the underwriting knowledge, the manpower, the talent, the data analytics, all of that, the actuarial skills, all of those skills, suddenly started beginning to be housed in India. And that is what I see as a very long-term and positive movement for the Indian insurance industry, wherein we can benefit from a lot of the knowledge, which is the best-in-class knowledge globally, to come to India in a much more meaningful way. While there are certain caveats, which have been done, in terms of the management team, needs to be from India, majority of the directors, needs to be from India. But I think, we'll have to see the fine print, but I think, again, I don't think there is any dearth of talent in India now. After 20 years, there is enough number of people available, who understand, the global insurance space and who are technical experts in everything. So to answer your question, I think all the existing JV partners, will again, look at it very differently in terms of playing a more proactive role for bringing in more knowledge, expertise, into India. I think, still that will happen. Also, some of them now depends on the JV partners. Some of them might be having existing arrangements, some of them might not. But I think, some of the JV partners, my understanding is definitely will be interested in increasing, their participation into India. The big joker in the pack, could be the Japanese investors. The Japanese, have been largely waiting on the sidelines, for very long. They are very, very large insurance players, and they've got deep pockets, and they are very patient. They are patient long-term investors. So I clearly anticipate, some of them, could clearly, come into, country like India and Japan. We have a very good relationship. So some of them, we could see that money flowing in. And I think, again, if you look at the European top 10, the American top 10, there are players, still who are, for whatever reasons, not been there in India. Either the 49 was a dampener or the management control was a dampener. So I clearly see, some of them, kind of getting into those conversations right now. So I think overall, yes, I see some of the existing JV partners wanting to increase. I see some new players wanting to come in. But I am personally most excited by the fact, that there will be much more inflow of knowledge and expertise into India as an insurance sector.
Thank you, Nilesh. In fact, you hit the nail on the head. You're right, absolutely. There will be Japanese companies who would want to sort of come into India, given the fact that they would like to have the control, knowing the Japanese mindset, the kind of mindset that they have is in terms of ensuring that there is a control of their organization on a company which they form as a joint venture. I think the most important caveat over here, and which is subject to certain clarifications, is in terms of setting aside a percentage of the distributable profits to a general reserve in the event the FDI limit is allowed up to 74%. Do you believe that's a good move, keeping in mind the fact that they would not expect all the profits to be of dividends, etc.?
So this is my personal view. I don't think that will be a big dampener. One is anyway, insurance, whether life or non-life, these are long gestation businesses. These are not businesses, wherein you invest your capital and, 1 year, 2 years, 3 years down the line, you get your returns. So typically the gestation periods or the cycles are 10 years. And especially if you're talking about strategic players, whether Japanese, European or American, I think, most of them, when they come into a country like India, the horizon is, more like decades, 10 years, 20 years, 30 years. So and the kind of opportunity, which is India as a growth market, so I don't think the idea is, to quickly make a return and then to repatriate. I don't think it's going to be a big dampener. I think India has a large opportunity. Most of these players are going to look at India for the long term, and they'd want to invest further into India's growth rather than repatriate, that capital.
Thank you, Nilesh, for sharing that perspective. Yes, I think it's a wait and watch as to how many players would definitely want to take an advantage of this particular increase in the limit. Let me switch to the other gear now, my next question is to Bala. Bala, you have been, of course, quite a renowned figure in the mutual fund industry, and I'm sure that you would be, as an industry expert and as an industry professional, would have expected some kind of important reliefs as far as the mutual funds and the AMCs are concerned in this particular budget. At least unless there is a fine print to it, I have not heard something significant about it. But there will be something which I'm sure you would have captured. So maybe how do you believe this particular budget has impacted the mutual fund industry? We have seen the ups and downs of this industry during the COVID period. And suddenly, of course, by July, August, it started to pick up and it's doing well. How is it doing currently, and what could be better in case certain things have not been rolled out by the finance minister in this budget?
Yeah. Thanks, Kushru, for having me part of the panel discussion today. Every year we used to give long list of our ask. Last 10 years, even I have been part of AMFI chairman. And every year I do need to debate and discuss what need to be represented. We simply used to look at what we have represented the previous year. And then each year we will see the applicability of the same recommendation. And then we used to send this to the Ministry of Finance. And this has been the practice every year. And most of the years we knew that nothing will get accepted. And in the first year, we are quite happy that something has been accepted. And when I mean something has been accepted is we used to make a representation since the time the brokerage structure, commission structure for mutual funds got changed and moved to a trial model. And then insurance industries had some good advantage over mutual funds. So when we used to make the representation, now this year, finally, they've accepted that. Basically, the ULIP, putting a cap on ULIP, and then bringing in tax applicability of subscriptions above 2.5 lakh rupees is something. They have done it on the recommendation of Mutual Fund Association, maybe aptly supported by SIB, and also aptly accepted by IRDA. That's why I see it. Otherwise, they would not have done it in any case. So that's something I see as the one good thing that has come. This, in some sense, is bringing in mutual funds and ULIP more or less at par, except the difference that they are given. Second, which is of course a bigger thing, which not many would have noticed, is I have not seen this coming in the headline anywhere. There is a mention about providing backstop facility for development of the bond market, especially the investment grade bonds. I think I'm also referring to the Vivek Iyer earlier comment on the German bond market in India is still poor. And this idea came actually as part of the discussion that we as industry member had with the SEBI during the post-COVID time, when the industry went through some tough time on managing liquidity on their portfolio, especially low-rated bonds. The idea came up that why not we get the backstop facility from the government of India itself, rather than going to either the banks or the Reserve Bank of India, asking for the repo facility. And finally, the government of India accepted it. And I was the chairman of that committee. Now, after I'm saying it is not in public domain. So I was one of the chair of the committee, and then gave the recommendation to SEBI. And given the fact that they have accepted it, that it is the need of the hour. So I see this is a big change because me and Rajiv, all of us have been discussing about corporate bond market development for so long. And I don't think any concrete one step would have been taken for development of the market. So this I see is one concrete step that has come from Government of India, which will have two impact. One, rising resources for companies which are below AA rated papers would become potentially easy. At the same time, for investors like us who want to actually invest in such kind of bonds without getting too much worried about whether there is going to have a liquidity or not, and given the fact that the backstop facility will be available with this government creating separate kitty, I would assume it could help in developing the market. As it develops from mutual fund point of view, since the mutual fund offers 60% of their AUM coming on the fixed income side, this could in some sense pay way for bringing some innovative product on credit-related instruments. That I see as a big change. Third, of course, which is nothing new. It's PF contribution now has been about 2.5 lakh rupees from employees contribution. Employees contribution about 2.5 lakh rupees and will be subject to tax on their income, which essentially brings back the debate and discussion about which are the instruments which can be comparable to each other, but which are more tax efficient. And the mutual fund fixed income generally is considered as a tax efficient, except the mark-to-market volatility, which is the one which drives away the investors' confidence. But leave aside mark-to-market volatility and consider the tax consideration as one of your area of investment, tax efficient way of investing, then naturally the mutual fund fixed income schemes would gain some kind of added advantage and pose these regulations. So there is no fine print issue that we have seen as an issue from industry point of view. So rather than the industry was quite happy, at least this time, a few of our recommendations have been accepted, which essentially means they are giving some importance to the mutual fund as a player, while they have been giving a lot of importance to the banking and insurance as a sector. And this budget seems to have given some kind of more weight for the mutual fund industry as well. So that's why I feel.
Sure, thank you.
Maybe Khushru, if I can come in
yes,
here.
Please, of course.
Yeah, so hi. So I think I would say that this budget is the second budget in a row where the finance ministry and the government has given a lot of emphasis to the financial service sector. I think there were a lot of smaller issues in terms of tax issues which are there, and policy measures which all have been taken in terms of check the box. And I think most of the sectors, if not all, within the financial service sector have got something or the other from this budget. So be it mutual funds, which has got some tax, push or level playing field, or in terms of able to now raise debt, in their mutual fund scheme. I think those are key positives for the mutual fund sector. And equally, in terms of other sectors, including insurance, REIT, InvIT, ARC, AIFs, Gift City. I think everybody has got something or the other in this budget. So I think it's a pretty good positive budget, especially for the mutual fund industry.
Thank you. And I think what I heard from Bala and you, of course, is the fact that the government is now focusing on the development of bond market in India, given the fact the bond market is so significantly held in high esteem internationally, especially the Western countries and the developed countries where it plays a very significant role. I think it started to gain a little bit of a momentum, and now I think there is a lot of emphasis. So it's definitely a reform in the right direction. Let me come back to Rajiv now in terms of my next question. And this particular question actually relates to the confidence enhancement as far as retail depositors are concerned in the case of banking system, given the fact that in the last budget, they increased the deposit link insurance coverage from 1 lakh rupees to 5 lakh rupees. And now they are saying that there will be a proper framework by which these individual depositors will be allowed to withdraw up to 5 lakhs, God forbid, in the event that a particular bank goes through a stress. We have seen and we have read in the papers, in the media, a lot of stress that has happened on account of failure of a couple of cooperative banks in the past. What kind of a framework, Rajiv, do you envisage would be there, and how seamlessly it would be run? And if somebody has got 10 lakh rupees as a matter of example, or 20 lakh rupees deposited in the bank account, either by way of fixed deposits or by way of savings account, and then only being allowed to withdraw up to 5 lakhs, and that also could be in a phased manner. How do you think that this particular framework will be able to achieve the overall objective of easing it out for the depositors in the event that stress?
Let me put this in two ways. One is that in India, the depositor has never lost money in the banking system. But if you look at it from a regulatory framework perspective, what you're talking about is that deposits up to 5 lakhs, which is a significant component of deposits in this country, are effectively guaranteed. So which means that by definition, anything above 5 lakhs, if a bank goes bust, you will lose money. I mean, that is the regulatory framework.
That's right.
But as we have seen, like you rightly said, even over the last, sort of 12 to 18 months, we've seen various instruments and methods that the RBI and the government have used to ensure the survival and therefore the fact that depositors have got their money back. In one particular case, in the Yes Bank case, there was a particular route that was used by the RBI of getting the banking system to capitalize this particular bank, and then now, and there's been a change in management, etc. And now the repair work, so to speak, in Yes is now well and truly in place. The other is Lakshmi Vilas Bank, where where they actually, which once again is a fundamental shift that's happened, where a foreign bank has been allowed to take over a Indian bank. And in this particular case, the foreign bank has a wholly owned subsidiary, and as a result of that, they were allowed to take over Lakshmi Vilas Bank. And so, therefore, what we've seen is different methods being used to be able to protect depositors. So what the budget has just done is, in a sense, fix some of the wrinkles that perhaps beginning because of the fact that we've seen some of these cases over the last 2 years, to be able to create a legislative framework that even when, and so today what happens is that there is no legislative framework. I mean, RBI decides, it comes up with rules and regulations during the moratorium period, etc., etc. That is now being formalized, if and when a similar situation happens as we go forward. But I just want to leave you with the same thing that I said in the beginning, which is one, that from a legislative or legal perspective, only deposits up to 5 lakhs are guaranteed or safe as far as a depositor is concerned. But having said that, we've never seen a depositor lose money in this country in a scheduled commercial bank.
Thank you. Thank you, Rajiv. Vivek, you have anything to share?
Yeah. Just in terms of on that, from a deposit insurance standpoint, what's one of the comments I heard as a part of the budget was that there will be some sort of amendments made to the act, or or some kind of an process being enhanced, so that the deposit insurance could be easily accessed by the account holders whose account are in question because of the financial institution being as a part of resolution. Now, from a financial institution standpoint, the FRDI bill earlier had spoken about a special resolution framework specifically for financial institutions. I mean, the bill couldn't be passed, but there still kind of is a need for a special resolution framework, especially with respect to financial institutions. And that's one of the, I wouldn't say misses, but from a hit and a miss standpoint, one of the miss that potentially they could have kind of looked at a similar special resolution framework for banks, because an FRDI bill, when it was actually launched in the past, there were not many instances in terms of recent instances of failures from a financial institution standpoint, even though so there was a lot of stress inherent within the system. We actually had cases subsequently in terms of where there was a need for a resolution. So the PMC Bank, the PMC Cooperative Bank is an example where a special resolution framework was genuinely needed to alleviate the pain of a lot of deposit holders that were there. I believe a special resolution framework for financial institutions may be one of the points that they should actually reconsider or relook at, because I mean it was something that was considered, and it was a very good well-structured bill. If I may, it didn't pass, it's a different story, but there's a good structure, and probably to relook at that maybe a good piece is one of the thoughts I had.
Thank you, Vivek, and for sharing your perspective. And as Rajiv rightly mentioned, that although these issues have happened in the past, a depositor has never lost the money, and let's keep our fingers crossed on that also, given the fact that yes, we would not want the depositors to lose, and I'm sure that the RBI is working hard to ensure that there would not be further failures and the kind of stress that normally gets created when there is a failure. Switching gears again to Nilesh. Nilesh, the biggest news in the insurance industry, the jewel of India, which I call as a life insurance, now having to go through the committed IPO route in 2021-22. I think it's a great move as far as the regulator is concerned. I have worked as a professional with the LIC of India in the past, and we all know the kind of wealth and the kind of strength it has, and the only organization which gives a sovereign guarantee in terms of its returns of the money, etc. Having said this, yes, it's a great move, and even if one has to even think that if LIC would divest 5% or 10% of the capital, I'm aware that this capital is only 5%, where the shares are held by the President of India. So even if at all you divest 5% or 10%, it can lead to a divestment income of anywhere between 75,000 crores to 120,000 crores at a minimum, rough guesstimate from my side. I mean, do you think it's a fantastic move to sort of privatize LIC? Would it give a more level playing field for LIC to be on the same platform with the private insurers, given that today also LIC will be having 65% of the life insurance market share after 20 years of privatization of the industry? So your thoughts, please.
No, first of all, I think the government seems to signal is very strong intention of privatizing or divesting part of LIC, which is great news. So the second, I would say, so what we saw last financial year, and one is, of course, the COVID and the lockdown, but there are very significant operational challenges it's a behemoth. And, in terms of understanding, dissecting, bisecting, this behemoth. And that, to my mind, is, the real challenge. So, for example, my understanding is, it's, even right now to understand fully the embedded value of, LIC is a big challenge. And I'm sure even when a lot of industry experts, will get their hands to it, it will be a big challenge. So, so I would say, the operationally, it's a big challenge. I agree with you, that the last 20 years, LIC has done a great job in number one, in infusing a significant amount of technology into their operations. So they have kept with the times, and they, whether it is the process of, renewal, paying an installment of premium, or, reviving a policy, any of that, I think they have really kept on with the times, and they have digitized, all their operations. Number two, they have also continued with their investment in distribution. And number three, and which is the most important factor when it comes to mortality risk in India, that the trust and faith of LIC brand name has been undiminished over the last 2 decades. So today, it is one of those brand names, which has become synonymous with life insurance. A lot of people in the rural, semi-urban areas say, "Mereko LIC chahiye." What they mean is, they need life insurance. So I think, it's a great story. It's a great move. I think, there's going to be operational obstacles, in terms of, the execution is going to be very difficult. Also, when you speak about the valuation, I was looking at the numbers of 3 of the peers, SBI Life Insurance, HDFC Life Insurance, and ICICI Life Insurance. So very roughly speaking, in terms of the new premium or the annual premium, total premiums, the premium wise LIC is approximately, give or take a few bips, they are about 9 to 10x of, each one of these 3. But in terms of profitability, when I was looking at the number, PAT wise, they are about 2 to 2.5x of these 3, entities. So, and again, if you look at the market cap, I think, HDFC Life market cap is approximately 1.3 lakh crores. And the other 2 entities is about 70 to 80,000 crores. So I think, the numbers, what you're talking about, it could be anybody's guess, between 6 lakh crores, to 12 lakh crores, is anybody's, guess. But again, and, maybe Bala and Rajiv could comment on that, but getting an IPO even for 10%, 60,000 to 1,20,000 crores, that's a large, large set amount of money. To get, that kind of long-term, good quality capital is, so, yes, Indian market has matured, but that's a lot of capital. Any circumstances, any this thing. So I think, yes, it's a great move. No two doubts about it. The government's intention is very strong. I just feel, that there will be a lot of operational challenges which need to be overcome. There will be a lot of execution challenges which will need to be overcome. I know there is the announcement was made by the finance minister to even to empower the legislative part of it, so that everything, all the decks are cleared. But having said that, so that is one part in terms of getting the valuations right and to reconcile all the data. And the second part, will be the valuation and the depth of the Indian market. So which, while it is a large amount, but again, maybe Bala and Rajiv can add, but I think, there is an adequate depth, so I think, there is the kind of bullishness which is there on the Indian market and the future of it, I'm sure we can get a meaningful participation, not just from Indian investors, but also from the foreign investors. I think there should be a good takers, for an issue for a size of, 60,000 or even 1 lakh crores.
Absolutely. I think, and the finance minister seemed very committed when she said that the IPO will be rolled out in this particular 2021-22 fiscal year. Rajiv and Bala, any of your comments to what Nilesh mentioned? Anything specifically that you would want to add?
On a more lighter note, if burger companies have seen the kind of oversubscription that we have seen, I see no reason why.
Absolutely.
And I see the premier entity in the life insurance business in this country cannot attract money is from local investors, foreign investors, local institutional investors, etc., etc.
Right. Bala,
I fully endorse what Rajiv just mentioned. My own assessment is once LIC comes up with IPO, this will probably be an Aramco of the kind of hype that got created for Aramco. I'm not comparing with the Ant Financial, which got withdrawn. Aramco, the kind of
absolutely. Vivek, I'm very sure.
That's something which I see as a big. No, I see that's the kind of response will come. Another thing I just want to highlight, I think what Nilesh mentioned about, you'll not even believe the kind of equity appetite that got created post-COVID period. First time I was seeing, being in the capital market for so long, first time ever, the number of companies have raised equity capital into rising debt financing. They cut the debt financing and then move to the equity financing. The kind of money that has come either in the QIP or in an IPO is one of the highest, I would probably say, in the last number of years I've seen. And equity appetite has gone up like crazy globally. I think that probably the government should take advantage of that vibrant acceptance is there for equity investing at this point of time globally. They should probably move their kind very fast and get one divestment done in either in the strategic sale or in the LIC IPO. Probably it could set a complete new game for the equity market.
No, I completely agree. Sorry, Khushru.
Yes, please.
Just to the point that Bala was making, one I think is if you can get one of these divestment / strategic sales going, I think it will fundamentally re-rate PSU stocks in the country. And I think the more re-rating that happens, is the biggest beneficiary is the government, and given the fact that the government has clearly shown its intent to divest out of many of these entities, I think that is something that will certainly play out. Just to give you an example, yesterday the finance minister mentioned that she is going to privatize 2 public sector banks.
Yes.
But she didn't mention which ones. So therefore, all public sector banks went up yesterday, and so therefore, just by that simple comment, the market cap of public sector banks has dramatically gone up yesterday. So I think the point I'm making is that if the government plays this right, the ability to create huge amounts of liquidity for itself and re-rate PSU stocks, I think is tremendous.
Absolutely.
So the intent, I think, apart from the equity appetite, I think what the government strongly indicated was the continuation of the liberalization agenda. And that I think, that intent to whether what we discussed earlier in terms of insurance, to give control to the, foreign, to the FDI foreign partners. I think some of those aspects are very important, because, that is, what's required for a successful privatization or divestment.
No, absolutely. I think it makes a lot of sense if the government goes that particular way. And I think one of the most important reforms over here also is that the privatization of 2 public sector banks and 1 public sector insurance company that they are considering. So if you ask me very honestly, I was thinking that where the calculations are going wrong in terms of the divestment income, because the government is anticipating an income of around 1,75,000 crore as income from divestment. So if you talk about LIC, and then if you talk about 2 public sector banks and 1 public sector insurance company, I think that number can be easily reached, to be very honest. So maybe I think the focus is going to be more on the divestment of financial services public sector organizations. So again,
Kushru, I think interestingly, Kushru, if I can just add, interestingly,
yes,
I think the point that he made, 1,70,000 crores divestment proceeds they're taking. We are used to taking 2,10,000 crores kind of number. Now this year they reduced the number. The probability of overachieving the number is very, very high. And the same way, if you look at the math and fiscal math,
right.
they are not actually considered too much of increase in the tax collections this year, despite projecting 16%, 15% kind of growth on the economic recovery, on the GDP growth, but they are not correspondingly increased the same extent on the fiscal side, on the revenue side. Whereas they have actually fully taken on the expenditure side. So my own assumption is this complete deviation from the earlier period, where you project a very rosy picture, but you underachieve it. Probably first time I'm thinking that probably they are under-promising and probably overachieve it.
Absolutely, that could be the reason. And as I mentioned, this 3 or 4 organizations itself can mop up to 1,75,000 crore and maybe beyond that as well. So absolutely point taken. Rajiv, 20,000 crore supposed to be pumped in as far as the public sector banks are concerned to ensure a better capital adequacy, to ensure a good ease of capital. I was talking to a couple of people, and 2 questions that arise in my mind is that how long is the government going to keep doing this? And is this particular number sufficient, keeping in mind the kind of stress the public sector banking currently is going through?
As we think about a $5 trillion economy, I think having a healthy banking system is an absolute imperative. And so therefore, today, if you see, much of the burden is being borne by the private sector banks, right, who have the brand distribution, risk appetite, and most important, capital to be able to support growth of the economy. But that is not enough as our ambitions are in the $5 trillion vicinity. And therefore, add some of the larger, of course, state bank, needless to say, in addition to that, you have state bank and, some of the larger public sector entities. But that still leaves, about 35 to 40% of the public sector banks who don't have the capital, don't have perhaps even the intellectual capital to be able to support the economy. And so therefore, one has to look at this in the context of not just pumping in capital, but also looking at, looking at the governance mechanisms here as well, to get independent boards, better quality managements, to be able to, support the new capital that is coming in. Because otherwise, it's just, throwing good money against bad, the point that you're rightly making. There is a lot of conversation around this. This is not something new. We've been hearing about this. There's a PJNAG committee that was formed, and it made its recommendations as well. One of the things that was anticipated was that there would be a holding company structure where all the government banks would be holdings would be transferred into that, and then, in a sense, separate out the ownership and management of public sector banks. Unfortunately, that didn't happen. Maybe that is something that could happen, outside the budgetary framework, as budget announcement framework as well. So therefore, to that extent, I think, it's not only the 20,000 crores which is important. There is a governance and management issue that we need to tackle as well. If the first step of privatization of some of these banks, works out, the probability that is the route that we will take is a strong likelihood as well. And I strongly support that maybe we need 4, 5, 6 big public sector banks, and the rest of it is with the private sector to be able to grow the banking system and to be able to support the ambitions that this economy has. I think, to the question that you have, is 20,000 enough? I also heard the finance minister say, let them use that, and there will be more if required. So I think to that extent, I don't think 20,000 crores is a small sort of number in the larger sort of budgetary numbers. For 20 to become 30 or 40, I don't think is a problem. But I think there is a more fundamental issue of management and governance that one needs to sort out as well.
No, absolutely. I think a couple of messages coming out very clearly from you. More consolidation in this particular space and more privatization as well, because banking will have to play a significant role if at all the dream to aspire a 5 trillion economy has to come true. So absolutely, I think I take your point. Vivek, anything that you would want to add on this particular point?
So yes, in terms of the 20,000 crore capital infusion that's there, in my sense, in terms of yes, it's the way I've kind of I think over a period of time my thought process has kind of evolved. Earlier, I used to say, oh, this amount is less, and then I figured that, oh, there always is more money coming in. So as a result of that, my intent always is that let's take the money that we get first, and then we'll ask for more. So on a lighter note, but yes, at least from that perspective, 20,000 crores is always a good amount to kind of have as a part of an exercise to kind of use as a part of that framework. Secondly, in terms of from a Basel compliance standpoint, level of capitalization, etc., the level of capital, if we have to literally kind of do that, and also the financial stability report that was released by the RBI, it had a very interesting statement to make. At a banking system, we are well capitalized, but there are certain individual banks who are not well capitalized. I mean, that was a very appropriate way of actually kind of capturing that, where there are some amount of banks essentially in the public sector space that would need a major amount of recapitalization from that perspective, and and that is something that they would intend to kind of achieve over a period of time. And I think also that the 20,000 crores should not be looked at in isolation. We should also kind of look at that in conjunction with the ARC structure, because the ARC structure also wants to kind of resolve some amount of bad assets that are already there. I mean, an important point to note here also is that there are provisions already made with respect to each one of the bad assets that are there within the banking system. So from that perspective, the hit on the capital has already occurred. So when there is actually this notional provision and the asset that goes out of the balance sheet and some amount of cash comes in through the ARC route, there'll be at least a great amount of relief, because that's a problem that's gone out of your balance sheet. And then you can start afresh, and of course, the credit offtake from that standpoint would also kind of increase. So in my view, 20,000 crores together, all the initiatives kind of need to be looked at in consolidation. I mean, if I were to really pick up individual points, I would always say, oh, this is not enough. But when we kind of look at it together, maybe some amount of benefit there, because it's, I don't want to sound like very NDTV on this one, and pardon me on that on a lighter note, but so there was an interesting anecdote I kind of heard on NDTV. I'll take less than 30 seconds on that. So Pranay Roy asked a question, which is that, how would you rate the budget? On a 10, is it a 12 out of 10? Is it an 8 out of 10? Is it a 7 out of 10? And the person on the other side said that, I would probably put it as an 8 on 10. 8 on 10 is a pretty decent number. And Pranay Roy kind of comes back and says, that's 80%. Today's schools require you to get 98% to get into a good school. Do you think you will be able to get into a good school with 80%? So, so it was interesting to kind of see that, diversity, and it's very easy to kind of say, oh, you missed this, but to look at it from a conjunction standpoint. Pardon me, I just thought I'll kind of lighten this up with some.
Maybe Khushru, yeah, sorry. So maybe just quickly, a couple of points on this in terms of recapitalization of banks. I think this is a good move. I think on expected lines. Equally, along with the stress asset being transferred to ARC, plus the setup of IDF, which will expected to have 5 lakh crore kind of a corpus in next 3 years to fund infrastructure projects. I think all three things put together is a pretty good lethal combination to have for the country, where we are staffed for good infrastructure and need a lot of capital there. I think it's all these three things will be quite beneficial to the infrastructure sector and the growth of the economy, and obviously which will have a ripple effect on the entire economy and the banking system.
No, thank you, Amit, for sharing your perspective as well. So what I commonly hear from all the three of you is the fact that this amount is currently sufficient, and if at all she has to consider allocating a little more eventually, I think that can be done. But definitely, I think it's definitely on the roadmap of better growth and better banking system in the country. So Amit, I was coming to you only now in terms of maybe you can share 2 or 3 important tax reforms, as far as the financial sector is concerned, focusing more on the GIFT City or IFSC, what we call as. What has been in this particular budget?
Right. So before I give, discuss about the specific changes in the budget, maybe with probably 30 seconds as a background about IFSC. IFSC means International Finance Service Center. I think globally there are more than 100 such IFSCs in various countries. And India was the only country till probably 5-6 years back that we didn't have a proper IFSC in India. And so it was high time that we had one. And I think so. This concept was introduced in the country around 5-6 years back, and the first IFSC was set up in Gujarat near Ahmedabad, which is the Gujarat International Finance Tech City, which is called GIFT. So we have the first IFSC, which is IFSC GIFT City. How it helps the country in this is that it basically is an SEZ, which provides a lot of tax incentives to the businesses which are set up in IFSC GIFT City or who invest in the stock exchanges in IFSC. So you have income tax rebates, you have GST exemption, you've got STT, CTT, stamp duty, etc. So a whole lot of exemption rebates which have been provided by the government. So this really is the critical and important point for to attract capital and businesses and units to be set up in GIFT City. With this background, in this budget, what the government has done is that it has probably brought in 3 or 4 key tax exemption or rebates. One is for the aircraft leasing businesses, which have been the priority of the government in last budget. There were certain announcements which were made in last budget, which I think which kind of it's in the same direction, and more SOPs and rebates have been given in this budget. So that's one. Given that India is one of the largest aircraft buyers globally, and hence I think it's a very good move for the airline industry. The second is the relocation of offshore funds to India, and there the government has given complete tax rebate, which is an extremely positive move. We know that till now, for last 2 decades, Singapore, Mauritius, etc., have been the preferred choices for a lot of funds to set up funds and make investments into India. But given the policy changes, tax changes in last few years, added to this particular thing is something which is really crucial and important to attract a lot of the offshore funds to shift to India. So I think it's an extremely important development. I think this will really have a lot of positive impact on developing our local fund industry in GIFT City. Third is the again the tax incentive given for the fund managers to set up their shop or units in GIFT City. Again, that will give incentive to a lot of fund managers based in Singapore and UK and other jurisdiction to probably think over shifting the base from overseas to India. I think those are pretty positive announcements which came through in the budget. So overall, I think a lot of emphasis, a lot of focus on GIFT City, and I think we would have pretty robust IFSC coming in our country in next couple of years.
Thank you, Amit. Thank you for sharing that perspective very briefly. One more question to Bala, and then of course we will take a round of what are the misses in the current budget. So Bala, one question I have for you is in relation to the consolidation of the 4 security laws, which are basically the SEBI Act, the Depositories Act, the Securities Regulation Act, and the Government Securities Act. I think these all have been consolidated in order to ensure that you have one particular uniform code for security regulations. Does it make life easier in terms of administration, in terms of management for the security regulations? Is it really impacting the mutual fund industry also considerably?
No, from a mutual fund industry point of view, of course, life is the same. It doesn't impact so much because SEBI has been a single point regulator for all the work that we do, including the one which we have to make a representation other than money market related or bond market related stuff right through the RBI. And most of the stuff we go through SEBI only. So in that sense, from a mutual fund point of view, it doesn't make too much of impact. But definitely the people who are dealing in the, say, securities market, dealing in stocks, deal with SEBI, dealing with commodities, deal with somebody else, dealing with earlier, if you remember that forward market commission used to be there in Delhi. And all such things now is coming under one umbrella. Is make it much easier from a market participant to deal with single regulator, all coming under one umbrella. And best of the practices that's being adopted in one market can be adopted in the other market. The very fact that the gold exchange is being now nurtured through SEBI as a regulator. Now all these things coming under one umbrella definitely bring the best practices under one. I think I would assume this is more or less in the same lines and which the mass monetary authority of Singapore functions in Singapore. I think it's coming more or less in the same line where you go to one regulator and you have a discussions completed within that regulator itself, rather than going to multiple places. That's something is very good. And in order to the earlier point, what Amit mentioned about Gift City, I would assume that they have made a huge progress on Gift City's development activities. Unlike the past, especially new chairman taking charge from Ministry of Corporate Affairs, he has been engaging with all of us as market participants. Even we are considering bringing in our Singapore unit to India under the Gift City and have that fundamental activities which otherwise resides in outside India. That's something which they are working on it. That I think they have addressed each and every pain points that all of us have raised, or the foreign minister would have raised. They are removed in this budget by giving special status, special mention about Gift City. This, in my view, it's a big thing that can happen. Probably will also help in a lot of the dollar-based leverage trades that happen overseas. Now that they have made investments made in Gift City is now tax-free, which essentially means banks like Bank of America or Deutsche Bank can have, Citibank can have their units there, made a lot of money in the investment, but still don't pay any tax. That's, I think, encouragement they are giving. And as a result of the dollar-based investing, which otherwise you have to tap overseas market, can happen in India itself under the Gift City.
Absolutely, I think, and Amit rightly mentioned that even, for example, if at all you have a non-resident bank operating in India, and of course they make investments out of the Gift City in that unit, from that particular unit, then even that particular income out of investments would be tax-free, which is also a very good move.
Right.
Now, coming to the misses in terms of, what have been the real misses in terms of the financial services industry as far as this budget is concerned. Rajiv, let me start with you. Of course, it's open in terms of your own share, your own perspectives. But one point I believe from a banking standpoint is a level playing field between the Indian branches of foreign banks and the domestic banks insofar as the corporate tax structure is concerned. We know that foreign banks in India pay a much higher rate of tax, which is 40%. And these foreign banks have been in India some of them have been in India for more than 100 years as well. Many of them, of course. And the domestic banks pay a much lower tax. This people were expecting, given my sort of discussions with some of these foreign banks, they were expecting this particular reform in a phased manner, not to come down straight away to the rate applicable to a domestic bank. So your thoughts on this, and maybe any other thing that you miss, that you felt has been missing as far as the banking industry is concerned.
So on your first question, I really have no comment. I mean, I think it's geopolitical, sort of call, I think, which is being made, because I think it is not as if other MNCs in this country are paying that higher level of tax, and so therefore it is only foreign banks who are paying that high level of tax. So I don't have a comment on that, really. But I think from a misses perspective, I think, I'd agree with, this NDTV comment that Vivek made. I think in general, we've got more than, sort of we asked for. But I think fundamentally what we are betting on, which is what I really like, is the fact that there has been a mindset shift, away from this, low fiscal deficit, and let's focus on that, to, fiscal deficit will take care of itself as long as, we drive growth in this country. And I think, as you think about where we are on the economic cycle, growth has to be, everything that we do has to be about growth. And I think if the government now begins to partner us as far as growth is concerned, I think that just means that it's only, good times ahead as far as this country is concerned. So I think from a policy perspective, I don't think we can dispute much. However, I think God is in the detail, God is in the implementation. How some of these things finally get implemented on the ground, how quickly we can get many of these things off the ground, I think is very, very critical. We spoke about disinvestment, we spoke about some of these ARCs, bad bank kind of situations. I think how soon we can get some of these off the ground, I think is more important than worrying about whether something should have gone down by 5% or whatever it is.
Absolutely. I think what you mentioned is the proof of the pudding is in eating, and to see how best these measures are going to be implemented in the right perspective and seamlessly as well. So Nilesh, beyond whatever you feel is appropriate as far as businesses are concerned, I see two benefits as far as insurance is concerned. You can dwell upon that. One is, of course, the GST anticipated reduction in the GST rate from 18% to 12% on the medical insurance premium. And I think a lot of people also felt that if affordable housing is something that the government is promoting in the current budget and have been over the last couple of budgets as well, whether any kind of rebate or reduction in the GST could have been offered on the home insurance as well to promote home insurance. Your thoughts on this?
So I would again agree with the larger panel, that I don't want to be nitpicking about it. I think there have been many more hits than any misses. Especially from insurance perspective, the 74%, the LIC, the one of the PSU GI pairs, being privatized. See, again, I'd like to spend 1 minute there on the PSU divestment. See, what it does is not just it is not the divestment target itself. But what happens is, there are right now in the GI industry, non-life industry, there are 4 PSU players, having a collective market share of 45%. The more players, in the industry we have who behave in a rational manner with, return on equity as the primary driver, I think it is very healthy overall for the development of the industry and the maturity of the industry. So I think that's, a key, because, when you have a shareholder who's looking at a social initiatives as a primary driver and not ROE. So I think some of these things, become, very important, and hence this divestment, I mean, it's going to be difficult, because the government had announced in the 2 years back in the budget, they had announced merger of the 3 PSUs. And I mean, a lot of deliberation went on, but for whatever reasons, I think there was operational challenges, and right now they then decided not to go ahead with it. And now they are announcing the divestment. There are 4 PSUs. One of them is already is a listed entity, New India. The other 3 are currently at a solvency level which is below the solvency level stipulated by the regulator. And by a very significant margin, not by a small whisker. So, I mean, just to give an example, one of the PSUs, while the stipulated margin is 1.50, 150%, their solvency is 0.02 instead of 1.5. So the point I'm making is, I think that's a divestment. It's a very good intent. There are operational challenges. Divestment is going to happen. This thing, but most importantly, I think the message was very strongly that the market conduct overall, the profitability of the overall industry, moves up, by doing that. So otherwise, from a misses perspective, Khushru, I really don't want to nitpick, but I think, yeah, 2 of the points which you mentioned, health insurance in the times of COVID, COVID itself has been the biggest driver of awareness in the Indian populace, and we've had health insurance take-up rates, going up very significantly, very, very significantly. And while the average ticket size, depending on what segment are you, but if I take an average ticket size of 6,000 to 7,000 rupees, any moving from 18% to a 12% slab would have been a meaningful one. So that would have really helped. And home insurance is something, which we keep on talking about every time an earthquake or a flood happens in India. But that's something, which awareness and is very low. And again, I think some of the incentives which we are giving towards affordable housing or home loans, some of that, if it comes towards home insurance, that will be useful as well. You're on mute, Khushru.
Thank you, Rajiv and Nilesh, for sharing your perspectives. I think what I heard is, yes, the business could be very negligible or very few, but definitely government has actually moved big steps in terms of ensuring reforms within the financial services space. So Bala, any thoughts from your side, given our other two experts believe that, yes, there are definitely much more positives than negatives or any misses. Any thoughts as far as your industry is concerned?
Yeah. No, I think they have covered most of the ground this time. Therefore, I don't think one should even look at anything that is missing. But having said that, the one I think which has been identified as a clear driver for creating employment, as well as bring back solid economic recovery, which is the housing sector, real estate sector. Though the state governments have done in terms of cutting stamp duty, etc., and the government also continued to focus on affordable housing. Probably they could have gone a bit more beyond the affordable housing in order to ensure that one, existing inventory gets cleared and activities get picked up, and therefore the whole related associate sectors start doing much better. So that one will probably they could have taken a bet. And of course, it's not been expressed by anybody as a concern from the real estate sector point of view. Then second, of course, the capital market point of view, although we are not, there's no much ask which was there, but having seen no significant contribution having come from the long-term capital gain tax, maybe given the fact that they also have a large pool of divestment that has to happen, they could have probably taken that bet in this budget, saying it's okay, nothing has come, and we'll remove that. Maybe they want to keep it optically. The LTCG, they want to keep it. Maybe this year, if it doesn't get too much of value add for the government exchequer point of view, probably the next budget they may remove that. This is my own personal gut feeling.
Thank you, Bala. Vivek,
yeah.
I just felt that maybe you would be more appropriate to talk about anything on the NBFC front, given that I don't think much is said about the NBFCs and the kind of liquidity crunch that they have gone through in the last 1 year or so. Any misses on the NBFC front you believe are there?
So two pieces to that. One is that in terms of a direct mention of a special liquidity window for NBFCs, that would have been potentially useful, and it's always me kind of wanting to also expect some direct guidance instead of a very indirect guidance, which the indirect guidance has actually been given through the whole backstop arrangement of the whole development financial institution for buying different fixed income securities. I presume that the brief, and I hope actually, I'm presuming and I'm also hoping that the brief would be to buy to create liquidity for securities for which there may not be enough buyers on account of a certain market event or a stress that may be experienced. And as a result of that, some of the papers that the NBFCs, or some of the fundraising activities that they may be doing, that institution may be kind of useful in some manner from that standpoint. So I'm kind of giving a benefit of a doubt to Ms. Itaraman also, in terms of that probably this backstop arrangement will kind of serve the liquidity needs of NBFCs. But yes, from an NBFC standpoint, would have kind of loved that whole special liquidity window being provided to NBFCs, being available to NBFCs, so that from a liquidity standpoint, it's really important for the industry as well. And in fact, on the whole graded paper for NBFC structuring that the RBI kind of released about a week back, it's quite interesting that even that particular paper doesn't really talk much about the liquidity window for an NBFC. So that the focus of that paper is more so in terms of how we are going to regulate so many NBFCs. I mean, it's more a paper on how RBI will address the supervisory problem rather than really the regulatory framework for NBFC. So a liquidity window, and probably it's also something that the Sundaram Financial MD, Mr. TT Raghavan, sir, he also used to keep saying about the special liquidity window. It's been an ask for quite some time. It would help because that's how the NBFC business is structured. I mean, to be very honest, when everybody said there is a huge ALM issue for NBFCs, it was not fair. in my view, because there was always an ALM issue. They always could borrow short term and had to kind of lend long term. That's how the business was structured, because even the term structure in India wasn't really developed. So I mean liquidity window could be useful, and that's one of the asks that will continue for some time.
Absolutely. So thank you for sharing that perspective. Amit, anything from your side which
Yes.
is a miss? But maybe more importantly, I would want you to add just one more perspective, which is a very important reform in this budget, and not many people have been speaking about it, is the advance tax liability on the dividend income, which will now arise only after the dividend is declared. I think it's a great move, I would say, in terms of the fact that financial services industry has significant amount of dividend income coming from investments besides any other sector. But it really impacts the financial services industry, and you really sort of, may not be in the best position to determine the dividend income over a period of time and pay accordingly the advance tax. So that's a great shift currently. So your perspective on that, please.
Yeah, absolutely. I think it's a great point, Kushru. I think this looks to be a small point, but it's got a lot of impact, positive impact. I think none of us can estimate the quantum and the timings of dividend that we will, as an investor example, one were to earn. So I think any investor into Indian capital market, etc., would earn dividend income during the year. Could be individual, could be financial institutions, etc. I think this is a great move. It's a very logical move, which the finance minister has considered and taken note of, and this will really save a lot of interest costs, which the SSCs were paying for almost so many years and decades. So small but very relevant and important move. Maybe one more sector which is not got so much probably emphasis on is the REIT and InvIT sectors, where there is, the finance minister in her speech yesterday mentioned about, I think, more than 7,000 projects which are to be kind of monetized through InvIT structure. There is something like 3.5 lakh hectares of land, which again is there with the PSUs, which may be monetized during the course of few years. And these two, elephants, I would say, in the room, in terms of monetizing and giving thrust to the infrastructure and employment and the economy. I think this can be easily be done through InvIT and REIT. For that, some tax incentives and raising of capital through debt securities have also been given in this budget. I think those are those are important, extreme, and relevant push to the REIT and InvIT sectors. In terms of my misses, I would say, hits have been there. I think, but there have been few misses probably, and those are the things to be kept for next budget. One is in terms of the insurance sector, life insurance especially. I think there are a lot of tax litigation which is there on various issues. I think most of the insurance companies are at High Court or Supreme Court level, and hence some more clarity on some of the common issues which are there could have really helped the insurance companies as well as the government in clearing that deadlock, and in terms of raising whatever taxes they can. I think that is a small miss, I would say. The other would be, certain for smaller NBFCs. I think the ask was that the interest income on NPA, etc., they should have the level playing field as similar to the large NBFCs. I think that's a small disappointed or a miss. Third would be in terms of the AIFs, Cat 3 AIFs. I think the industry has been demanding for pass-through status like Category 1 and 2 AIF, which is not coming. That's a small disappointment. And last is on the FPIs. I think there was again a demand that that 5% beneficial tax rate on interest income should be extended to interest income on which is on a higher side. So there are 3 or 4 small misses which are there, but overall I think it was a good budget.
Absolutely. I think it's really delighted to note that everybody is aligned in terms of the fact that there have been definitely bigger reforms and significant reforms in comparison to the misses. So we must give the credit to the finance minister and to the government of India on rolling out a very good budget insofar as the financial services industry is concerned. Before we wrap up, Amit, there is one question for you, and there is only one, sorry, I think the question is gone. It's been deleted, sorry. So I think that question was in relation to, many of these companies had holdings in international locations like Cayman Island, etc. and now it is moving to the IFSC as well. Government is encouraging. So you've already spoken on that. So I think it's a reiteration of the same concept. So I think we can wrap it up now. So thank you. Thank you very much. Thank you very, very much, all of you, for being there this afternoon to share your candid perspectives about the impact of this particular budget. And most importantly, also sort of even talking about what could have been better. So definitely, I would say that it's a wait and watch. But this particular sector is definitely on the radar as far as the government is concerned in terms of growth. As Rajiv, you rightly mentioned that if the Indian economy is supposed to become a 5 trillion economy at some point of time, banking and financial services would play a significant role, given the fact that this particular sector again cuts through all the other sectors. And technology, and we've not even spoken about it, but technology and digitalization has played a significant role, which even is evidenced from the fact that even in the current COVID times, most of us could operate virtually, even as far as the financial services sector is concerned, whether it is operations, I could say even from an audit standpoint, audits are virtual, company operations are virtual, everything is virtual. And thanks to the digitalization and the technology which these organizations have developed over a period of time. Thank you, gentlemen, for being here once again. Indeed a pleasure to have you, and have a wonderful day and the rest of it. Thank you so much.
Thank